Stephen, talk to me about why gas prices are down over the last month.
Yeah, absolutely. When you tank the U.S. economy and you put the consumer up against the wall, they're going to respond. And demand for gasoline is well below normal at this point in the season. When we go ahead and we seasonally adjust where we expect demand to be, and when we do our analysis, of course, we're going to take out 2020 because when we had the severe demand destruction. So we're not even looking at those levels. But when we're looking at gasoline demand, that has been the driver right now in the pullback in prices. Unlike what Brian Deese, the White House spokesman, who claimed about a month ago that the SPR release was 100% solely responsible for the pullback in gasoline, I just don't get it. Back in June, gasoline prices peaked at over $5 a gallon. When you look at the last 46 Junes, prices were 60% higher than the real, i.e. inflation-adjusted average of the last 46 Junes. In July, even though we've had this pullback, prices are still 40% greater than the last 46 Julys. So yes, we've had a bit of a pullback. This is solely because of a pullback in demand here in the United States. And that said, we're still looking at much higher prices. And of course, this is beginning to transition into the earnings that we are now seeing reported by the big oil companies.
Stephen, there's a lot here and a lot to unpack. I want to hone in on one aspect of what you were saying, which is when you tank the economy, then you can get lower gas prices. I want to take issue with that because the earnings that we're getting, yeah, they might be weaker than in previous years in terms of the magnitude of beats, but they're still okay. And there is some constructive data out there. Do you think that this is as a result of what's going on with Fed policy and the weakening statistics, or is this just a logical demand side response to prices that were too high? Did we see where demand destruction kicks in?
Yeah, no, I'm certainly on the boat that this is demand-driven at this point. You know, a little bit of the change in the calculus that everyone has had to deal with now is the impact of substitutes into the market. This is something we've never had to factor in, and of course, I'm talking about EVs and hybrids. So that threshold, that pain point for Americans, where before it was about $3.60, $3.70 retail at the pump, this is the price point that we began to see demand destruction. Of course, that's risen over the years. You know, I personally, as an anecdote, I drive an electric hybrid. I get blended about 70 miles to the gallon. So I'm not as sensitive to price as I was 10 years ago. So that threshold has certainly moved higher. And clearly, with gasoline prices now at above $5 a gallon, we are now starting to reap that benefit of the demand destruction. The consumer is responding. And let's keep in mind, we've also had substitutes, but the other thing that we're dealing with we never had, and this of course is COVID, the lag of COVID demand destruction. And what I mean by this is one of the reasons why gasoline was always the most inelastic as far as demand was concerned is because, one, we always had to drive to work. We always had to drive our kids to school. We no longer have to do that, right? We can work, and a number of us are still working from our homes. So even if as companies have opened up, and you know, again, an anecdote, my daughter, first job out of college, she wants to go into the office 5 days a week, but her office is only open 2 out of 5 days, and she has to work from home for those 3 days. So we have that optionality again, which is again raising the price. But even with substitutes, even with our ability to drive fewer miles, demand destruction, of course, is starting to react to this.
Well, obviously, there's optionality here in the United States, Stephen, but in China, sometimes you don't have an option and they just lock down entire aspects and groups of cities as there's outbreaks. That doesn't seem like a policy changing in the near term. If and when it does, how does China factor into this price equation when that demand comes back?
Yeah, absolutely. I think that's an excellent question, because clearly the problem, and this has been the problem, is we're not addressing the long-term structural imbalance globally between supply and demand. And to your point, demand is still masked. And look, this is what caught the industry, all industries, airline industry, food industry, so forth, flat-footed on the rebound of demand from COVID. And to your point, we're not even fully back on that demand. So yes, we are adjusting here in North America America and in Europe. But in China, because look, what Xi says happens, when he can shut down entire cities as he does. But if and when we ever do emerge from this COVID nightmare and that demand comes back, we're going to be in the same exact position that we were in the early 2000s. And what was that position? We went from the 80s and 90s where we underinvested in oil capacity, oil production, because the demand wasn't there, and oil prices for those 2 decades lingered at well below $20 a barrel. But when demand started to come back in full force after 2000, after the dot-com recession, it wasn't just the United States, it was Europe, and of course now it was China. This is when China's economic engine really became a factor. That is what was the key driver of driving oil prices from $40 a barrel to $150 a barrel.
It's always the way.
In a short span. And that's where we're going this time when China finally does come back with their full demand in this market.
Stephen, awesome to get your view on things.